So let me get right to it and I'll introduce each one of you. Our order today is going to be Trey, Michael, and then Steve, but I'm going to introduce each one of these esteemed gentlemen individually, and then I'll give them their time. So Trey Wilkinson is President, CEO, and Chief Investment Officer of Trinity Legacy Partners, a private wealth advisory firm here in Houston, having earned both his bachelor's and master's in business administration. And Trey has previously served as our chair of the Alumni Association Foundation Board of Directors not too long ago. It seems like just yesterday, but it wasn't too long ago that Trey was leading us. So thank you so much, Trey. Let me introduce to you also now Michael Sachs, founder of Galen Financial, and he has received several financial advising and wealth management awards in recent years, a 97 graduate. Michael also currently serves as treasurer of our Alumni Association Board of Directors for the Alumni Association Foundation, and has given well over a quarter century of his volunteer time to the University of Houston and in many different capacities. And finally, Steve Goodman is a CPA and CFP practitioner and founded Goodman Financial Corporation in 1988. Steve earned his bachelor's in hotel restaurant management and master's in accountancy from the University of Houston, and currently serves as the vice president of Eric's Club, a very distinguished group of alumni in the Hilton College. So I hope you all will help me welcome those three gentlemen here today to give you not only their time, but their expertise in bringing you three different segments in their introductions, and then we will move into some open question period. And I know, Trey, either you won the coin toss or you lost the coin toss. I don't know which one it is, but you are going first today. And if you want to go ahead and get us started again, I'll thank you so much for being here today. We've known each other more than half of our lives. And so
yes, we have.
I tell people all the time, in a concept like this, you can either volunteer or be voluntold. I'm not sure which one of those occurred to get the three of you to join us here today, but we do appreciate you. So Trey, the floor is yours, my friend.
Well, good evening, everyone. Thank you very much, Mike. Appreciate everybody. I guess we used to say dial in. I guess they zoomed in today for today's call. So thank you very much. I just want to, I guess, kind of lead us off on a couple of topics that may be important. Obviously, there's been a lot of what we call volatility in the stock market in the last, certainly since February. And the two things I really want to make sure that people, certainly it's okay to make changes to your asset allocation, but for goodness sakes, it's very important to stay invested. And why should everybody stay invested? I know people say, well, I want to get in now and I want to get out then. And it's extremely, extremely difficult, if not impossible, to time the market. And I know there was folks that were trying to get out on March 23rd, which seems to have been the low in this current correction, that were, say, okay, enough's enough, and I want to get out of the market, and I'll get back in when things settle down. And the market's risen about 32% from March 23rd. Now, people may not realize that, but that's a pretty big move in just over a 2-month period. And if you were not invested in that, or if you decided to get out and wait to get back in once things have calmed down, then you missed a pretty significant move in the marketplace. And remember, the only time you have losses is when you actually sell a position at a loss. You can, this is not going to the casino. This is not putting money on black or playing blackjack. When you're investing, you own shares of companies, and companies do things, and in doing so they create goodwill, they create cash flows, and I've been telling clients a lot during the last 2.5 months that you own shares in companies that have economic value, and that economic value may change day to day just based on what the stock market's doing, but it's really, really important to be in, if you're investing, stay invested in the market. Now, that does not mean you don't make changes to your asset allocation. That's very common. I think it's very important to have an asset allocation that that is comfortable for you. Most people, that's about 60 to 70% of your assets in stocks or equities, ownership of companies, and 30 to 40% in bonds or fixed income, particularly if it's in a retirement account. And that way, you can kind of smooth out some of the volatility that happens in the market, which is going to happen. It's going to continue to happen, I'm afraid. So, but the importance of asset allocation is to help blend out these so-called, bumps in the road, so to speak, staying invested is also very important. And then I want to just, before we segue out, there's for people that have been really adversely affected by the whole COVID-19 pandemic. In the CARES Act that the Congress passed a couple months ago, there are 3 very important provisions regarding access to dollars in retirement plans. That these are not things that you could do beforehand, but you can do now. And just keep this in mind. One of those is that if you have money in a 401k plan, you can actually borrow up to $100,000 depending upon how the plan is written, and everybody's plan is different. But Congress has allowed people to borrow up to $100,000 of their 401k plan and be able to spread the payment of that back to the plan over 5 years. So in doing so, this is not taking money out and having to pay tax on it. You can actually borrow money from yourself. When you pay the money back, that interest goes back into your account. And it's an important change that happened with the CARES Act. Another important change with the CARES Act is if you have money in an individual retirement plan, or what we call an IRA, you can now take money out, you make a withdrawal from your IRA, and not, if you're under the age of 59 and a half, you will not pay a 10% penalty that is normal. You will pay taxes on the money unless you put the money back into the plan. And there's also a provision of the CARES Act. They'll give you a period of time to put the money back into the plan, in which case you may not pay any tax. And the last thing for those of our alums on today's call that may be at retirement age, which is 70 and a half, historically, you have to take what's called required minimum distributions, or RMDs, out of your retirement plan once you get to age 79 and a half. In this year, those have been suspended. So you certainly can take money out of your retirement plan, your IRA, but the required minimum distribution has been suspended for this year. So if you don't need the money, you can leave it in the account and let it continue to grow. So again, the importance of staying fully invested, the importance of asset allocation, not having all your eggs in one basket, have some bonds, have some stocks, have some large cap stocks, have some international stocks. And then the 3 changes with the retirement plan that Congress did with the CARES Act. Hopefully that will help everybody when it comes to this COVID pandemic. So.
Thank you so much, Trey. I really appreciate it. As I went through the introductions, I know he's on a time schedule today, so I'm going to sneak in here, Michael, before you start, because it's not often that we get one of our deans that joins our webinar. Unbeknownst to me, he just snuck in. So Dean Paul Pavlou from the Bauer College of Business is on. Dean, would you like to say hello at least, so you'll come to the front screen?
Absolutely, yes. Well, thank you very much, Mike, and thank you very much, everybody, for the panelists for being here and helping with this great event. So I've been taking notes when Trey was talking, so I know where to invest my money. So always, investing in the stock market is a roller coaster, but as Trey said, staying in, even if it's low, is actually better than trying to jump out, because you never know when you're going to be jumping out. And it's probably scarier to jump out of a roller coaster, if I can give you my 2 cents on investing. And I hope nobody listens to me and listens to the experts here. So thank you very much again. And it's a great pleasure to be here. And very much looking forward to hearing more from everybody. Thank you very much.
Thanks so much for joining us, Dean Pavlou. And that looks like a drone photo you have there. I might have to get one of those of campus. I haven't seen that one before, with SEMO Hall behind you and the Insperity building, and that's first class right there. I might have to get one of those from you.
Actually, I have quite a few happening, so I can always change for the mood.
I'm sure. Thank you so much. Thanks for joining us. We really appreciate it.
Thank you very much. Thanks.
All right, so Michael Sachs, you are sandwiched between these 2 esteemed gentlemen. It is your turn up to cover what you would like to throw out for the group here this afternoon.
Thank you, Mike, and thank you, Dean, for being on. And I also noticed that Glenn Lilly was on. Glenn, I'd like to thank you for being really one of the influences of the leadership that we were able to do with Frontier Fiesta and Frontiersman and a lot of other organizations. So good to see you. And it's always an honor to be with Steve and Trey, just 2 of the business's best, and more so 2 of the best alums I know, and the amount that they give back and everything else they do. So it's an honor to be with those guys. In addition to the home improvement projects that you're doing throughout COVID-19 and cooking new dishes and baking bread, this is a really great time to really start to do some of your personal financial projects. And so I'll go through a few of those, and it's really just if you did a couple of them, it's great. If you do them all, good for you. But it's just kind of some ideas of things that you can think of, whether you're just starting to invest or you've been investing all your life. And so the first is just about retirement contributions, which is if you are currently contributing, great, continue to do so. If you've never started, it's actually a great time to start or even increase it. In fact, in March of this year, the savings rate for the United States reached 13%, which is the highest number it's been in 40 years. To give you a little piggy bank analogy of why it's important to start investing or to invest in your company plan, or if there's a match available, especially if you're growing up and you had that piggy bank and your parents told you if you put $1 in that they would match it. That is literally free money of what you put in. And so I think it's really important that when you're thinking of your match, at the very least, make sure that you're taking advantage of that, whether it's the company or the government or wherever you're working that has a retirement plan. If they're matching, a great start is to just think about reaching that dollar for dollar match. Of course, to really hit your retirement goals, depending on what those are, it most likely will take more than that, but at the very least, don't leave money on the table. That's really free money. Now we're going to talk about some buckets, like the short-term bucket and long-term and medium-term. And what I'm really talking about here is the idea of separating out your goals and thinking about a short-term bucket being 1 to 2 months, medium-term 2 to 5 years, and long-term 5 years plus. And if you have a short-term goal of 1 to 2 years, the market or things that might go up and down in value may not be the place for that. In fact, if you're thinking about saving your 3 to 6 months of living expenses, that's a short-term bucket. Your medium bucket may be saving up for a down payment in a home, or your long-term could be retirement, or even paying for college for a child that was just born, or even a grandchild that you have. And when you're starting to think about those, oftentimes we get asked, well, which bucket should I do? And the truth is all of them. Now, we may question whether or not you might, if you're trying to get that house faster or you're trying to get your expenses, you may front load some of those. But if you're waiting to start and you're thinking, well, one day I want to retire, when do I start? You start now. And when you start to think about what those medium terms are, the answer is not, let's just focus on one goal. Let's focus on all of them. And if it's, I think when my daughter was born, I started putting away $25 a month into her account. And then each year that I could add to that, I kept increasing it. But if you're trying to start when they're 10 or 15, that's not the time. It's going to be pretty hard to catch up. So it's just some kind of best of class ideas is to really start siloing out what your goals are and then invest accordingly to what those look like. Also, we're hearing a lot about interest rates being low. That means it's a great opportunity to look at your debt. And you can look at your credit card debt, your mortgage rates, you can look at student loan debt, and really start to think about how you're going to prioritize this. One of the popular questions right now is, should I refinance my mortgage? This is a good time to review that with a mortgage expert or even looking online. Typically, rule of thumb is if you can save 1% or more over a period of time, it makes sense to look at. Rates are toward their all-time lows. And when we really start to think about this, people are like, well, is it an all-time low? What we can tell you is in the last 80 years, we have not seen interest rates that look like this. So it's a great time to look. Even if you got a mortgage, depending on when you had it in the last few years, it's a great time to look at that and just see if it makes sense to refinance it. One thing that people don't talk a lot about is the car loan rate. So if you went to the dealership and whether it was a used car or a new car and you bought it and they gave you financing, you can refinance that as well. And so this is a great time. Contact your credit union or your bank or look online about just, can you save a few dollars by refinancing your car loan? On the credit card side, many people have debt, some do, some don't. Student loan debt's typically low, but the credit card rates can really fluctuate. And if you have one card or two cards or three different debts, it makes a lot of sense to look at what that maximization would look like. You can Google, how do I pay off my credit cards? And I'm not talking about the credit counseling services. I'm more talking about just looking at if you have a 17% rate and a 10% rate, it doesn't take long to figure out that if you'll pay your maximum payment to the 17% and the minimum payment on the other side, and then kind of catch those up, it will allow you to pay those off quicker. So think just a little bit more mature when it comes to what you pay and how often you pay it and when you pay it. And then, of course, on the mortgage, oftentimes it makes really good sense if you're able to just pay a little bit extra each month. You'll see that debt decrease as well. Plenty of calculators online. And I know that Mike afterwards is going to send out some information And we'll send that out as well, just to give you some ideas of a calculator on what that'll look like if you paid a little bit extra on your mortgage. Let's switch gears and just talk about legal. Mike has not given the idea, he hasn't made the statement that while we're giving you advice, of course, all the advice
I was just getting ready
to you. This advice is really overall, and you should seek professional help in each and every realm. And my next kind of topic is the legal documents and getting those in order, not because we're attorneys, but because we know how important this is to your overall financial well-being and truly just your sleep at night factor. I think what's most amazing, and many people on here know that I'm a stats guy and a nerd guy by nature, but I'm amazed when I hear this number that 2/3 of Americans do not have their legal affairs in order. And that stat has actually gotten worse, not better, over time. And we're not just talking about having a will. Just on that, we're under 1/3 of America. But obviously, a will is important. But there's other things that are even more likely to occur, or maybe not more likely than death. That will definitely occur, but more so just to think about how you can make sure that you put yourself with the best odds in your favor if and when something happens. And that includes a medical directive, which is directing the doctors as to, do you want to live on life support? Do you not? A power of attorney. So if you were hurt in a car accident and somebody needed to pay your bills for you, you've already designated who that would be. And that person may be different than a medical power of attorney, which would be the person you want to make medical decisions for you if something happened to you. So I know that the person who is going to make the financial decisions may not be the same person I want to make the medical. And you absolutely can have somebody specifically named for that, and more than one person. Rarely are you going to want to have two people simultaneously, but you'd certainly name different people. And then also now in today's world, the HIPAA release, which would then allow people to get information on you if you were in the hospital and they just want to know medically what that was. My religious institution is listed on that. Mike Paday is listed on that. So Mike could find out. He doesn't even know he's listed, but I've listed quite a few people that absolutely could get information. So if something did happen, then it wasn't just, they were allowed to get it. And I have my friend and my office administration and people like that that are listed so they can get the information they need. Of course, I'll give my caveat again, always seek legal advice. I'm just broadly based saying that these are things that really don't take a lot of time. They're not very expensive, but more importantly, they're really important for you and your family when you start to think about things that from a legal side. A budget. Now, the word budget may be the most offensive word that I found. We used to always ask people, do you use a budget? And everybody says, yeah, or no, or I don't know. You can throw that aside for a second. The budget's super important. See, when you have $1,200 a month and you're in school, or $400 a month in school, you know that your budget ends when your dollar ends. That's actually not a budget. On the flip side, just knowing where you spend your money and looking that there's almost 50 participants on this call right now, and most likely, most of us cannot tell us a percentage basis of where our money goes. In fact, if you looked at where your money went 3 months ago, I suspect that eating out was a much bigger number than it is today. But just thinking about getting the basic version of Quicken or something like that, that'll allow you to put your credit cards and your checking accounts and link them up and just see how much you're spending and where you're spending your money. That alone, we know statistically will change your behavior, but more so it'll also make you look and say, is my Massage Envy membership worth it? Maybe it is, maybe it's not, but you can make those decisions. But you can really look and go through whatever your, what's really important and what's not, and where's your money go. It's really interesting when you start to run those numbers. 20 years ago, we would constantly see mortgage and some other things be your highest rate. Now we're seeing health insurance in a lot of ways. Many times it's technology costs. So we keep thinking technology costs have gone down, but between your Hulu account and Netflix and all the other things, you start to look at that and realize it's a pretty significant number of what you're spending. So once you know what you're spending, you can decide if you're going to use a budget. I suspect if all you do is just look and find out where your money's coming, where it's being spent, it will help you identify some changes. The next one, again, switching gears, is to the insurance review. We're not just talking about life insurance. We're talking about your property and your car. Take a look at your home coverage and make sure, many of us did this, after Harvey and through tax floods and a lot of other things. We're not just talking about flood insurance. We're also talking about rental insurance. And does it cover what you think it does? And is it doing what you want it to do? Do you need more? Are you paying for too much? Oftentimes we look at it and you may have a home and you know that the home's probably not going to blow away if you're 50 miles inland of a hurricane and you're covering the entire home value and not the studs or whatever that may be. But that's what you talk to your insurance person about. And you also look at your car and say the same car you've now driven for 10 years, you may not need full coverage. You may have the money insured in a different way, or more so you need the liability by state law, but are you insuring something that's really not as valuable? So just taking a look at that, and more importantly, running a quote on your car insurance. Most people do not run a quote after they've gotten it. Once they've gotten it, they stay with it. And the companies are oftentimes more favorable to their new customers than their old. That is not a business model that Steve or Trey and I do, but it is a business model that the insurance companies absolutely do. And so it makes really good sense. And this is so easy to do online or to call them if that's what your preference is, but to just look at it. That's also true if you own a business and you're looking at your commercial insurance. And you can even go to your commercial insurance agent and let them know that you really would like an analysis of your coverage and to quote it against 2 or 3 other companies. Again, it just makes sense to look at that. It's not just about cost. It's also about having the proper coverage for what you're trying to accomplish. And then on the life insurance side, it's doing an analysis to define if you're accomplishing your goals. Many times, in fact, life insurance has gone down in cost, not up, over the last 20 years. And as we're thinking about whether that may be as an income stopgap, so something happened to you, how do you provide for your family, or you're planning for college, or whatever it may be, it's important to run that analysis. I know Steve and Trey can run that. It can also be done online, but it's really, really important to think about, am I covered for the worst case scenario? And it can often be done for a fairly low cost. Rather than cost, I really like to think more about, does the insurance you have do what you think it does? And I say that because most of us are covered at our work. If we quit or switch jobs or get fired and our health has changed, some companies allow that to move over or to go with you personally. Most do not. But you need to know that answer now, not when you leave. And so it's just a great opportunity to ask that question to your benefits. Do I have the opportunity to take the insurance with me? As an example, you're sick, you're no longer at that job. Obviously, we're seeing reductions in the workforce today. Does this give me a chance to go with me, or what happens if my health changes? So just ask those questions, and if not, look for yourself. If you have a policy, you've had one for 20 years, you would be amazed what those numbers look like, and oftentimes it makes sense to look at. So just totally running both the analysis of cost and benefit and which ones do what they want. Most importantly, if you don't remember anything else, please look at your beneficiaries. I know that there's people who are smiling because they heard me talk about it, but when I left college, I got married 2 years later. My mother was still listed as my beneficiary for the next 5 years. I would highly recommend that if you no longer are married to your spouse and you don't want your former ex to get your life insurance proceeds, that you consider looking at your beneficiary and seeing who that might be. True story. I promise you, Steve and Trey have seen this happen in their practices as well. This is your time. Find out who your beneficiary is. And it's just simple. And to ask that question, it's the same for your 401k. It's the same for any account that's a retirement account. This is your chance to look at your beneficiaries and ask it. And then lastly is just doing a risk analysis on your portfolio. And Trey talked about staying invested. I know Steve's going to give us a great economic report as well. What I'm going to talk about here is just knowing if your personal risk analysis, what that looks like. In other words, if you are not comfortable with your account going down 30% or 20% or 10% or 50% or 0%, then you should run that risk and know what your current investments look like and do they match your current risk tolerance? Because Trey knows how to invest your dollars and Steve does and I do. That's one question. But the real question here is, are you comfortable with how your investments currently look, or how your 401k is currently invested, or where you're going? And there's plenty of opportunities to do this. Hopefully your advisor has the ability to look at this and really back test your current portfolio to past market cycles. What did it look like when the bear market exists, the last 2 bear markets? Or what did it look like on the bull markets? And also, what's the effect of your portfolio if interest rates go up? What happens if interest rates go down? I don't know how much further they can go, but what does this look like? And then evaluate that and make sure it's in line with your personal comfort zone. My last story is just simply that we had 2 clients come to us 20 years ago. They were 2 brothers, twin brothers. They both had $1 million. And at the time, that just seemed like all the money anybody could ever need. And one, I said, how'd you do it? He said, every time I had extra money, I just bought Exxon stock. And the other person said, and he explained that to me, and I looked at his brother and I said, well, what'd you do? He said, I said, you buy Exxon stock? And he said, are you kidding me? I would never buy Exxon stock. I wouldn't buy any stock. I couldn't sleep at night if my portfolio went down. He said, I just saved a lot more than my brother because he was comfortable with the market going up and down, and I would never be able to sleep at night. They both had roughly the same amount of money. One just saved differently. And I think that's the importance of making sure that rather than listening at the water cooler where you should be or on CNBC, it's really important to talk to experts that are on this Zoom call, but also to know what you're comfortable with and making sure that those two are aligned. So that's what I have.
Thank you so much, Michael. I appreciate it. And you did sneak in. You're right. I was neglected in giving this is a casual conversation between alumni giving their place. If you listen to what they have to say as advice, that is fine, but you should consult your financial advisor for actual moves that you would like to make. Do not base it on something that you heard on this conversation. I'm sure, as Michael mentioned, they'd be more than happy to have a conversation with you, but don't base it solely on a 1-hour Zoom webinar hosted by the Alumni Association. Please, be a little more in depth than that. So that's a bit of our disclaimer. We don't have one of those, I laugh now about all of the medical commercials. The first 10 minutes are what it'll do for you, or the first 10 seconds, and the last 50 seconds is all the ways it will kill you, right? We want to make sure everybody takes this with the right mentality. So thank you so much. And now the man who apparently joined us knowing that the market was going to go up 500 points and be over 25,000, and the oil was going to sniff close to $40 a barrel again. Ladies and gentlemen, Steve Goodman. How are you, Steve?
Thank you. I'm doing fine. Thank you, Mike. And I appreciate being here. And I'd like to just echo everything that Trey and Michael have said. I'm in 100% agreement. I think we're always all on the same page, always providing, prudent advice from our experience. My topic is more on the economic and update and portfolio considerations. It's hard to do these things in a very short period of time, but I'm going to try to hit on some major things. The first thing to point out, though, is the stock market is a leading economic indicator. It goes up before the economy really can demonstrate what it's doing, and it goes down before the economy takes a hit. It's a leading indicator. And really, when it comes to the markets and the economy, people don't really get scared until the market goes down. Market goes down, then they panic and they want to sell. And as we all know, you're supposed to buy low and sell high, or at least incrementally, but people tend to panic and sell low. I'll also point out that stock market typically goes down about once in every 4 years. And so anybody who's doing any kind of financial planning should be basing their financial planning and their expected returns based on historical market averages. Market averages have the down years in them. You don't have to avoid the down years just to achieve the averages. In fact, you can just sit it out. That doesn't mean you need to be imprudent, but understand that the bad years are in those averages. So then the next thing is, so why did the market collapse, and was it justified? The fact is, going into this, actually things were pretty darn good. When we look at it, unemployment was at about 3.5%. GDP was running at about 2% growth. We had 126 consecutive months of expansion. It was the largest or longest post-war expansion. Things looked very, very good. And this was a very different situation than you'd normally see. But what happened is really it was government action. Government action shut down the economy. When I say government action, I'm talking about federal, state, and local governments. Now, was it right or wrong for them to do it? What they were doing was trying to protect our health. And there's no one size fits all when you're trying to protect health. And so what it did is it did a lot of damage. But just the same way they did that in order to protect the health of this nation, they also had a responsibility to help mitigate the damage and try to some degree reverse it. And when you talk about what they can do, you really, when you deal with finance, you might recall there's monetary and fiscal stimulus. And basically monetary is the purview of the Federal Reserve. and fiscal has to do with what Congress and the administration would do. So basically, they stepped in to reduce the panic, and because people were panicking. And you know what? It's funny because I actually had a client email me and say, "When is it time to panic?" And the reality is, it's never time to panic. You should not panic. In fact, I think it was on March 9th, we sent out an email to all our clients. We communicate regularly, but we actually sent one specifically about why you should not panic. And what we did, though, is we did it with information, because if you actually take a look and say, okay, you want a leading indicator, all you had to do is look at the COVID cases in China. And you looked at the COVID cases going up, you looked at the curve flattening, and you saw it going down and down. And so what we did is we looked each week and said, what's the Chinese curve? What's our curve? And the reality is, once you can look at it, that a society can control this to some degree, can flatten the curve by taking action and diminish the curve, then you realize that the situation is temporary. And when it's temporary, that's certainly no reason to panic. In fact, anything that is out of equilibrium or out of whack is going to be temporary. But despite it being temporary, the reality is there's been tremendous job losses. I mean, there were multiple weeks where there were 6 million unemployed. There was newly unemployed, and right now we're at about 22 million unemployed. About 1/3 of those are people in the hospitality industry. The hospitality industry has been really hurt more disproportionately. In fact, they've taken it on a chin to help keep us safe. You know, the government stepped in with the PPP, the Payroll Protection Plan, very large stimulus, $1,200 a person for people who don't make over a certain amount of income. And then the other thing that really is a major factor moving forward is this extra $600 a week of unemployment. So when you take a look at the populace and you look at saying regular unemployment benefits plus $600 a week, there's a whole bunch of people making more money being unemployed than they were being employed. So as businesses start opening up and businesses are trying to rehire people, some of their folks, quite honestly, whether to be safe and avoid COVID exposure, or whether it be because they're making more being unemployed, it's actually makes it a little bit difficult to kind of unwind the situation. The reality, though, is that extra $600 a week expires on July 25th. And I would guess after that happens, you will see mass number of people looking to return to work. Now, the Fed, when it comes to the Fed and monetary policy, a lot of people with the super low interest rates have been saying the Fed's running out of ammunition. Well, the Fed never runs out of ammunition. The Fed basically, the only way they would run out of ammunition is if they ran out of creativity. And each time we go through these things, they come up with new programs. They come up with new ways of doing things. And where it's customary for them to do things such as lower interest rates and maybe buy government bonds, buy mortgage bonds, this time they look to buy corporate bonds. And in fact, just one really odd situation that developed is people weren't just panicking from the stock market, but they were panicking on the bond market. The bond market is not nearly as liquid. There aren't as many bonds traded. And what was happening is, you know, if you want to sell a bond, you could go ahead and get a bid and look at the price and say, no, that's a ridiculously low price. I'll wait. I'll get a better price. If people are asking for redemptions from a bond mutual fund, the bond mutual fund could pick and choose which bonds to sell. But a lot of people these days, they're investing in bonds through big bond index funds, ETFs, exchange traded funds. And when people redeem ETFs, what's happening is the people who are governing those ETFs, they're needing to sell proportion amounts of all the bonds. And if you try to sell something when there's really not a market for it, then you have ridiculously low prices. And then people are panicking because bond prices are plunging. And actually the Fed stepped in, first starting to buy investment grade short-term bonds, then intermediate bonds, and then they actually went and started buying junk bonds. And once they did that, it just kind of shored up the bond market so people weren't panicking. But nobody would have ever expected the Federal Reserve to be buying junk bonds on the open market or actually buying them straight from redemptions from exchange traded funds. But you know, when the Fed does this, there's some pretty smart folks there and they normally make a profit. And the good news is when the Fed makes a profit, it actually goes back to the US Treasury. So that's just one thing to consider. The other thing is there's a double whammy here in that we have oil prices plunging, especially for those of us in Texas. If you think about it, at the beginning of the year, West Texas Intermediate was at 61. It went down into the 20s. In fact, as we're probably aware, it went momentarily into the negative territory, went negative, but it kind of stabilized in the 20s, has made it back up to the mid 30s at this point. But clearly anybody in the fracking business is really been wounded. The businesses are wounded. It's going to reduce drilling, which is going to reduce the oversupply. And in the meantime, as the economies of the world, both U.S. and international, as they kind of get back moving, think of it as a locomotive back on the track and starting to gain momentum, the demand will be higher. And as demand is higher, but supply is lower, we'll see those prices go back up. But right now, second quarter GDP growth is expected to be negative 8.8% on a year-to-year basis. Good news is small business surveys are starting to look a little bit more optimistic than they would. Some of that is they've gotten their PPP money. Some of them are applied to the Fed's Main Street lending program. I just talked to a client earlier who's benefiting from both of those programs. But regardless of what you're looking at, when it comes to investing in your own finances, you really have to look back at what Trey and Michael were talking about is, first of all, you should have an appropriate asset allocation. You should have been harvesting your gains and rebalancing your portfolio after the huge gains of 2019 and not riding it up and up and up. You should be harvesting some of those gains, rebalancing so you didn't have as much in the stock market when things hit. You should stay diversified. But then you look at what the headwinds and the tailwinds are. And just in my last 2 minutes here, I'll just comment on those. The big headwind right now is COVID. Really, there's some people are very concerned about the reopening of the economy. They're concerned that this flattening of the curve might spike back up. But so far, early data is showing that the curve is staying flat despite the reopening, and other countries have shown the same. People are worried about a second wave of COVID in the fall. There's disruption of supply chains, especially when it comes to international trade in China. So those are risks. There's certainly risk to the travel industry, the hospitality industry, and really risks to anybody who has too much debt. An impaired balance sheet, excess leverage is the worst thing to have when you go into this type of situations. And the tailwinds, those things that make you go faster, technology is proven itself once again. Technology is allowing us to speak on Zoom right now. And for those of us who've been conducting our business on Teams and other things using technology, I know 14 of our 15 people are working remotely. I'm just the steadfast one who just felt like coming to the office every day, but it worked. And actually we still have people working remotely. It's allowed us to do our long-awaited office renovation. And there's construction people are staying busy, not just here in our office, but across the city and across the country. But technology is doing well. But commercial real estate is a concern. We're not, most people are not expanding their offices as we are. But there are some opportunities. In fact, residential, if you think about it for a moment, a lot of us have learned that we can work from home. If we can work from home, we don't have to commute to work. We've also learned that if we have two earners at home, we're kind of tripping over each other. We're wishing we each had our own studies, our own space. And what you might see is a whole bunch of millennials moving out to the suburbs where they can get a whole bunch more square footage and not have to worry about the commute because they're working at home. So maybe residential home builders would be an opportunity, but really just kind of use your own intuition about where the opportunities and the risks will be. At this point, I'll turn it back to Mike.
Steve, thank you so much. And so we'll open the microphones up for Trey and Michael and Steve. And we do have one question. And if you all have a question, or at least you want to ask one, I think we have a very trusted group here. So if you'll put, I have a question in the chat, or put your question in the chat, we'll come to you. Gio actually has a question that I had on my list here to ask. So we'll go right to it. It says it was mentioned that the pandemic is a temporary event. The economy will come back. Does the panel foresee any semi-permanent impacts of this once in 100-year event? And I was going to ask, what are the long-term effects of the relief bills that have been passed? So maybe that's a two-phrase question. Who wants to take a first shot at that? Trey, or just chime in, whoever wants to go.
I guess I'll take a stab at it. Certainly, there's going to be long-term ramifications because of the amount of debt that's being, I guess, accumulated by the U.S. to pay for the stimulus package. Now, that is obviously at very low interest rates, and there's a lot of academic folks out there that maybe have different opinions about the long-term effects of it. But the bottom line is that there is a tremendous amount of money that's being borrowed by the U.S. government, and I'm not sure we can say at this point what the ramifications are going to be. In terms of business opportunities, and Steve did a great job of talking about a lot of things that are happening in residential homes, housing, perhaps. I think what has happened is a lot of people realize they can work from home. And what does that do to air traffic going, down the road? And what does that do to hotel occupancy? Both of which, surprisingly, have increased quite a bit in the last month. I've got some things, we call them green shoots, but let's see, hotel occupancy was up 9% last week, and people going through the TSA checkpoints has actually tripled from where it was on April the 12th. So people are getting back and getting back to some sense of normalcy. But I think it's too early to tell about the long-term ramifications of what this has done. What I do think that people don't like being cooped up at home. I think that's one thing that came through, loud and clear. And once they feel comfortable getting out, I think that they will.
Steve, did you want to add to that? It looked like you were chomping at the bit.
I'll just add, when it comes to the deficits, they're very worrisome. I mean, when we started having $1 trillion deficits, after the Great Recession, that was scary, but it was just for short term. And now we've got multi-trillion-dollar deficits. It is scary. It is fortunate that we're able to borrow at near zero interest rates. Right. And what you'll see with the Treasury, you'll start to see them refinancing the debt at longer and longer time periods because the yield curve is starting to go up and they don't want to end up having to borrow at higher rates. And as long as they can keep debt service low, it's not that much of an impairment, but it's certainly not a good situation. And it is a headwind to economic growth in the future.
Michael, would you like to add anything, or would you like me to go to the next question?
No. I mean, just to pick up on that, I think the question was, what changes we think we'll see over time as well, and they definitely addressed the debt and the different things that are occurring. I think Twitter's announcement that they are indefinitely going to allow people to work from home, and companies are doing that, and even my own company that's now looking at and saying we've been more effective working from home than we've ever been sitting in the office. So now we're saying from a commercial real estate perspective, right? Do we, on our next lease, do we really need as much space, or do we think about how we're doing this? And I think productivity, they're not seeing that decline. In fact, I think all of us on this call, or many of us, are finding we're working more now than we were before. And we may have that problem of how do we separate the two, and that's a work-life balance issue. But I think there's some real benefit in having these meetings, right? We have our board meeting on Thursday, and I think we're going to find that board meetings and things like that, and Glenn would tell you from the rodeo, having their annual meeting online, I suspect they're going to have better attendance and more people participating than they typically have as a result of just this forcing us into that. So, not all changes, right? How do you train somebody just online, and how do small businesses do that? There's problems. There's a lot of benefits to this. And I think people are starting to look at this and saying, how can we take the good from this? Because there's a lot of bad, and will that be lasting? And I think the answer is yes. There's some real changes that are going to occur, kind of that black swan moment on the flip side of just, we're all thinking about things differently and looking at ways that things are getting better. And then also looking at how bad we miss some of that social interaction, and how do we bring both together. So that's just my thought to add to those other two.
I knew you missed me. Okay, so Charmaine has a question, a very good question. For those who've already retired, some investors saw significant decreases in their fund balances during the down days of the market during COVID. What advice do you have for retirees to recover from those losses? Who wants to take that one first? Steve? That seems like it's in your wheelhouse.
Yeah, it's, the first thing is hopefully nobody has too much allocated to equities. And then when you have this kind of pullback, your equities will be below their target. And when they're below their target, at some point, and I know it's a little bit nerve-wracking, you actually buy more low while things are down. That would be the best thing to do. And so then you're buying more at a lower price. when things go up, and then you have large profits, and then you harvest those profits. If you're not able to actually make that move, just patience, because the reality is markets will rebound, because ultimately the market is just the combination of the value of individual companies based on their ability to have earnings and provide dividends. And most companies, especially those with strong balance sheets, will do just fine. There will be failures, and it's stressful, but just patience, because these kinds of things do happen. And Charmaine, I'm glad you're on here, and thank you for the question. See who else has some answers.
I have a question really quickly too, Michael. This one's for Michael. I wrote this down because if only a third of the people have a will, maybe we can give them some facts that will make them get a will. If you don't have a will and you pass away, where does that money go?
So you're asking the financial advisor the legal question? That's a beautiful thing.
No, just the factual question. If you don't have one, it just where does it go?
Yeah. So each state is different, and I know that given this Zoom call, that I don't want to just talk about Texas, but
right.
there's clear delineation of what occurs. Typically, it goes into the estate, and then the claim is made on the estate. I will add to Steve's point, what an amazing opportunity. So I think when the market went down, and frankly, I don't think anybody, Trey nor Steve or I, obviously, none of us know if the market's going to be a W or a V or a swoosh, which I didn't even know was anything other than a Nike emblem, but I've learned that. We don't know literally which way this is going to head, as nobody else does. We have some ideas, obviously, and individually we do. But what a great opportunity that was to look at your portfolio and to say to yourself, are these companies I really believe are going to make it? Are these companies I really believe in? And do I know what XYZ company does? And if you don't, it's pretty hard to own it through a downturn. But also, we saw something a couple months ago that we haven't seen in a long time, which is Steve's point. We saw the opportunity for you to make a list of the 10 companies you've always wanted to own and really determine if the valuations made sense at that point. So I think this is still a great time. Why not make that same list and say to yourself, do I believe in what I own? If the answer is no, probably ought to talk to your advisor or talk to somebody and figure out why you're still holding on. There's a difference between good, hope and prayer and good basics and fundamentals. And Steve's talking about the fundamentals. Hope and prayer is not an investment strategy per se. So, if you bought something or you own something that you don't even understand or why you own it, this is the time. But even more so, what a great time to say, I love, and I don't want to name any company, but you like some company you've always wanted to own, and you make that list of 5 or 6, and when those hit those valuations that are comfortable, you buy them. So I think there's great opportunity. I mean, the downside, as everybody says, and there's plenty of Buffett quotes out there, we know these are the times that you really can make great investment decisions. And as Trey talked about earlier, it's the time to stay away from the bad ones, the bad financial decisions.
And if I could add one thing to that, Michael, a lot of companies, and Steve touched on this a little bit, but a lot of companies are paying fabulous dividends that are called kind of unintended, high dividend payers. So if you are retired and your portfolio is taken, unfortunately, a bit of a downturn here, to Michael's point, take a look at these companies that are now paying, in some cases, 6% dividends that obviously weren't there just a few weeks ago. And what you do is when you buy the stock, then you lock in that dividend as long as you own it, as long as they continue to pay it. And I think cash flow is always a very, very important part of any investment strategy. It's like dividends to a portfolio is like oxygen to us that we have to breathe. So that's the only other thing I would add is take a look at these higher dividend paying companies. Make sure the balance sheets are solid. I think Steve definitely touched on that, but there's a lot of really good companies, and you can lock in a great cash flow from here.
And we have time for one more. So Ryan asked a simple question, if you could see it in the chat, to fill in the last 3 minutes. Any insight on how the China-U.S. trade pressure will affect the economy in the next 12 to 24 months? Anyone like to take a run at that one? So Ryan asked, he saved the easy question for the end. I thought, Glenn was thinking about asking it, but Ryan beat him to it. So let's just say that. Who wants to take a run at that?
I'm happy to jump in on the first side of that, which is there's a really great chart that shows that prior to COVID-19, the tariff talks continuously got louder as the economy did better. And when the economy was going not as great. In this, we're not talking about the last 2 months, just the last 2 years. The tariff talks got quieter. The one thing we know about both countries is we actually need each other, right? I mean, at the end of the day, there's no question that we're not going to shut down all imports or exports, or this is not what we do. So I think it's really going to be important to recognize that. I think the question went all the way out to 24 months. There's no way of knowing what that looks like. The net effect of COVID-19, which I know is the topic of today, is we will see closer supply chains. And we will see, whether that's in the United States or whether that's Mexico or a lot of different options, I think we're going to realize that single source supply chains isn't going to be the future. So this will make us reevaluate some of those things. But the trade with China, the buying power of China, the population of China, the middle class of China, if we look back when Steve's been doing this longer than I have, and certainly Trey as well. We've all been doing it for more than 2 decades. So there's some basis there. But, 20 years ago, we didn't see a whole lot of car ownership in China. Today, in our households, we all see 2 cars or whatever that may be. The middle class of China doesn't look like our middle class of the United States. And that's going to continue to grow. And the globalization of what we do is not going to go away. And we're going to want, as American capitalism, to continue to see those opportunities. So I would just say that there's a lot of noise right now and there's a lot of negativity, but I think both parties know the importance of each other and our capitalists and their buying power and population growth and everything else. So I just wanted to add that.
I'll add one item, and then maybe Trey will finish off this topic. But just mathematically, when you look at China, they have a lot of cities with 10 million people, 20 million people, 30 million people. And we're talking about a country of 1.3 billion people. In our country, we have one city of 10 million people. If you do the math and if you start shutting down trade all over their country because people aren't buying from them, people are changing their supply chains, and you take, let's say, 10% unemployment in a city with, just say, 20 million people, that's a lot of unemployed people. And I know not everybody's in the workforce, but when you start having cities with millions of people unemployed, you could get into civil unrest. You can get into issues that no country wants to have and that could actually cycle out of control. So just from a standpoint of needing to keep their people on them, to keep them employed, I think that even though our relationship with China may get worse before it gets better, I think as you started by saying, it's in our common best interest to work things out. And China really does need us.
Thank you so much. And that brings us to the top of the hour. Perfectly timed off there, Steve, with the crossing of the T and the dotting of the I. I want to thank everyone for participating here today. Really, really great information. There's plenty of more information out there. We will be posting in the chat and on our website the contact information for our 3 gentlemen joining us here today. One of these days, by the way, those of you who are watching, I'm going to call on Case Keenum and not Shazia because her background is so prominent. I'm just going to say I'd like Case is raising his hand, and I'm going to ask see if he'll answer the question. But thank you all so much for being here today. We really, really appreciate it. My day was made by the information that you gave me, and then I got to see the blessed Glenn Lilly's face today on video, which is one of my favorite people in the world. And thank you. And Steve, we're all thinking about you. So thank you for being here tonight. We really appreciate it. Housekeeping. Remember this, it was recorded. It will go on our website at houstonalumni.com. You can follow up and share it with other folks. We will put the contact information up there for our friends here. And one of the things we didn't get to really quickly was we have a lot of young people out there that are, just graduated and they're looking for financial advisors. And that's a big deal. And I know you guys would be happy to help just give a conversation of what we like to how to pick a good financial advisor and what would fit that person's personality. So thank you all so much for being here. Thank you to our team for running this. Thank you all for participating. On behalf of everybody at the University of Houston Alumni Association, I want to remind you our next webinar is on June 10th. Lord willing, we will be talking about sports, good sports, coming up with Matt Thomas, Bill Worrell, and Robert Flores. Steve Goodman has promised to get with Major League Baseball, the National Hockey League, and the NBA. He's got time. He's in the office. He's going to figure those 3 things out, and we will get those sports playing, so we'll have something to talk about. We won't be discussing college football till we have facts. So thank you all for being here tonight. Please enjoy the rest of your evening and go Cougs.